everybody, good afternoon, and welcome to 12-Minute Trading. My name's Doc Severson. I'm joined with Dave Lukas over here, and today is Monday, the 29th of April. We're just about done with the fourth month of the year, and it's been exciting lately. We've had movements all over the place, 50-plus point moves on the S&P just about every day over the past few weeks. We've definitely made a transition into our market character. And even today, we've got movement all over the place. And guess what else we have this week? We have Fed Week, as well as some other major tech earnings and jobs at the end of the week. So, Dave, where do you think we end up by the
we
end of
literally
this
started
week?
this call and the thing started selling off. So I think it's a crapshoot this week because it's all going to come down to Powell, right? I think Amazon's going to do well in its earnings tomorrow. I think AMD, probably do fine. Apple earnings, I think, are going to be poor again. I just think Apple's just they seem to have missed every quarter for the last 3 or 4. So maybe a surprise there, but I think Apple's just going to kind of be trodden along like it's done. So it's all going to come down to Powell this week, and it's all going to come down to his tone on the meeting afterwards, the presser, right? So they're not going to they're not going to lower rates. They're going to say they're data dependent. They're going to say that, that the inflation is ticked up. And so it's probably going to make it harder. They may have to wait longer. You're going to get all of that type of speak. So it'll really come down to his presser and see if he makes a bigger, mistake in his speaking or comes off more hawkish than people anticipate. We were talking about before this, and actually the first couple of weeks of May, you've heard sell in May and go away, but traditionally the first couple of weeks of May, if you do like the average for trading for, going back, so they track trading, the first 10 days of May are typically down days. So, it would be very easy. We've come up to a really nice point in the charts, and you can show this when you pull them up. We've come back to basically the moving average in the middle of the Bollinger Bands on the daily chart, came right back to that level. That's a great level right where there is resistance from prior support. And so it would make a lot of sense to roll back over from here, put in the low, and then get ready for that summer rally that we typically get. So I could easily see that happen, but you can see everything's just tagging right at that level. And then the prior support is just right there. There's like the whole confluence there. So to roll back over would make a lot of sense. That's kind of what we're waiting for. And I think this week will help dictate that.
Yeah, it's interesting. We have, there's so many things going on here on the chart. So first of all, if we look at just I'm going to actually see if I can increase this part down here. So let's increase the price. This is what happens to a lot of times if we have too many studies on there. You tend to disappear the price. But if we put fib retracements on this move, you can see that we've just gotten up to the 50% fib retracement. And what's important about this is that the 61.8, which is right around 50.50 or 51.50, excuse me, on the cash index, that represents the last line of defense for the bears. So if the bears are going to keep control of this, it has to stay below 51.50, because what we normally find is the 61.8 fib retracement is kind of like the last line of defense. If we see a close above there, very likely that we will fill in the triangle here. And that means going all the way back up to 52.65. So you can see we are very, very close to that point. So if Dave's theory is correct, we might come up to there over the next day or two and then maybe fade back down again. Is that going to lead to a lower low or a higher low? A lot of that depends on where we see things going. If you look at where we did last year, or I'm sorry, this past fall, we did the same kind of thing. We came up to that fib, we faded at the fib and made a new lower low, came up to another lower high, another lower low. So we had a 3-month corrective period, which was good for about 10%. So far, we're only down about 6%, which is identical to the initial swing back here in August. So
yeah, if you look at like even October, you had that rally back up before you put in the low.
Oh yeah.
So
right,
It's kind of a similar type, action like that.
right. And then,
And there's a lot of things lurking out there, right? So, Japan is in real trouble. The yen hit 160 overnight, and then they intervened, and then it was already back up there. So that carry trade issue is back. And then you got obviously Powell this week in the Fed. So there's just a lot of landmines out there. It's another one of those weeks you just kind of let it play its hand, and then you take advantage after it's over. Let the carnage happen.
the interesting thing from a technical perspective on this is that we are still dealing with, on paper, an exhausted monthly chart. So even though the trend is still very strong to the upside, there's a limit at which typically when we see something like this with these low levels down here, we'll typically see a couple of months of red candles that show up, a couple of months of red candles. Usually that's all that's necessary for this to recharge and to see the energy, the potential energy for the next trend come back into play. The interesting thing, though, is that the weekly and the daily charts
charged up.
Yeah, essentially are ready to go for the next trend. When we see something like this happen, where we see a parent time frame which is in exhaustion, yet the child time frames are ready to go, typically we'll see a counter trend move from here. A counter trend move makes everybody happy because these charts, they just want to go somewhere. They don't care where they go. It's just like a child, right? Just like, I just want to do something. I don't care where I go. I don't care what I do. I've got energy to burn. I just want to make something happen. So a lot of times we can see these types of moves. A move to the downside makes everybody happy. And so we're sticking with a 4,800 level, which would be 4,800 is a swing test on many different time frames. And it's good for 10%. Now, with that said, if we see the swing test 4150 broken through, the 61.8 fib broken through, and the price clearly heading higher from there, we have to salute and say price wins. Price is always going to be the final arbiter of value, regardless of what all these indicators say. At the end of the day, it's always price, especially at the very, very end of a swing. Sometimes crazy stuff can happen.
The thing that we have to just understand, traditional just market, and yearly just movement is you get a summer rally. And you'll bottom somewhere. It ranges when you bottom, right? It can be in May. Last year we bottomed in like June 15th ish, I think was the bottom before we had that massive rally through August. But like having a sell down that puts the fear into everybody and makes everybody think that, this thing's over, and, that's what you need. That's where typically good rallies that happen over several months are born from. And think about October, right? And how people felt, and everybody was talking about S&P, 3,000, and all this was going to happen. And then we got a rally in disbelief in all of that, just nonstop for 4+ months, right? So it doesn't have to, but it's easy for me to see us getting some nastiness into May, maybe based off the Fed this week or something with earnings or Japan or I don't know, something else. It just needs an excuse to kind of really cement that fear and that kind of low to where everybody thinks, okay, it's over, we're the year's over, we're not going to rally anymore. And then that's when everything kicks in and goes back up, and we rally through the summer. Then we get the softness September into October before the election. Then we rally after the election on the certainty of the election. Now, this year's an interesting year with the election because both candidates are really a known commodity. Like the market knows what it's getting if Biden's reelected. The market knows what it's getting if it gets Trump because it's had it before. So I think regardless of who's elected, you get a rally into the year end. Okay. Next year, though, 2025, all bets are off because with where our debt is and everything else at that point, who knows what's going to happen. But that's how kind of I see this year playing out, and that's how I'm kind of preparing to trade things for the last 6 7 months of the year.
Yeah, whoever gets in inherits a mess into 2025.
Yeah,
I don't know
yeah.
how do they fix that?
Yeah, and if and I don't think it's guys. I won't get on one of my political soapboxes, but I think if Biden gets in, you'll keep they'll keep deficit spending at a very high level, right? Unless Congress completely changes over, which I don't know if that'll happen, but he'll continue to deficit spend. That's how he'll keep things propped up. We just had 1.6% on GDP, and we're spending trillions of dollars in debt to get that. You know what I mean? So that'll continue. If Trump gets in though and puts a kibosh on it and austerity, well, guess what? Now you don't have that propping the economy up. So do we go into a recession? I think either way, it's a bad spot that you're in, right? I think you get a recession either way. So that's just, I mean, the laws of economics eventually catch up with you, and that's just the way that it is. So
let's talk about Wednesday's Fed meeting. What would Powell have to say to either goose the market or to depress the market on Wednesday? What are the keywords that the market algos are going to be looking for in terms of his response?
I think he if he says inflation's like stubborn, and what we expected isn't happening, and we are we're going to have to keep rates higher. We don't, especially if he's like, I don't think if he says anything that's like, I don't think we can cut in July, because right now the market's betting on July, right? So anything like that, I think causes a sell-off. I do think that the other way is if he's like, all this stuff is happening and he talks about Japan, we're willing to step in to support the economy or support things. If he starts saying stuff like that, then you're going to get it the other way. Because I do think if there really is a carry trade blow up, that the Fed will step in, the Fed will cut rates, the money printers will really start back up, and everything else too. I think Yellen's been on the phone with Japan like every day saying, don't sell those bonds. I think that's because that would just flood the market. They're our largest holder of debt, of treasuries and bonds internationally. So if they start flooding the market with those things, look out. The Fed's going to have to do something.
I wonder if he's going to. I think we've talked about this at length over the last 2 years as to whether or not a 2% inflation rate is a realistic goal, which I think a lot of people are coming to the realization.
He's not coming. They're not coming off that at the Fed though.
But if he does get off the 2%,
then
is that gonna be viewed positively, or thank God he's finally come to his senses?
I don't know, because it would depend on if they say that they're going to start cutting. If they say that, and then hey, we're at a point where we can start cutting because we're going to raise our inflation bar, right? Then the market likes that. If he's like, we have to raise that bar, but we're not going to cut, then the market probably doesn't like that.
The other thing too that was a real shock last week was the GDP number. Like we've had really pretty good GDP numbers for a while, which have come in, 2 to 2.5% for several quarters in a row. So nobody's really trotted out the R word lately, but all of a sudden,
$2 to $3 trillion deficits.
Right. So all of a sudden now we missed, and we missed badly on the GDP number.
Mm-hmm.
So the R word starts to come in.
The real economy is doing very poorly.
Yeah.
And the only thing propping it up is still that spending. And I think everybody realizes that.
Especially government
I was doing some preparation for our monthly mastermind meeting with our group tomorrow, and the real unemployment rate is at 24%. The real inflation rate is at like 26% if you go to Trueflation and look at the real inflation rate since 2020 or 2021, I think. And so like you can mask anything with statistics. Everybody's heard that before, but the reality is the reality. And I think everybody out there knows that. I think anybody who goes grocery shopping or, has to live an everyday normal life, you're not cutting out food, energy, and housing like in your numbers, right? You got to pay for that stuff. The price of a house, the monthly payment to afford a house is the highest ever. You now have to make $110,000 a year to afford a medium priced home. That's up over $30,000 in the last year and a half alone to afford a home. So, that's real. That's absolutely hitting people, and it's underlying there. That's why I said you can continue to prop it up with government spending, but at some point you're going to get that recession out of it, and it's going to be a nasty one.
Yeah, the next one could be kind of bad. So, hey, for those of you out there live today, there's a pile of us out there live. Let us know if there's any questions. Are there any topics that you'd like us to cover for today? And of course, if you're watching this on a replay, which is most of you, is there something that you'd like us to talk about next week in next week's session? We'd happy to queue that one up for you guys with next week's session. So let us know if there's something out there.
Charts were rebounding a little bit here. My call is I think by the end of the week we're going to be lower, unless there's a big surprise. I just think we're going to be lower, and that coincides with the time of year. And I think that could get a little rough into May. When we hit that bottom, everybody's going to be scared, and then bam, we run higher.
Yeah, so we almost we gapped up today, so we almost have filled this gap down there. I think this is what this run was for, but generally we're kind of running in the opening range here today. So this also tells me this is based on tick charts, and a tick chart means that each candle depends on having a certain number of transactions. For this, it's 1,000 transactions on the S&P equals one candle, irrespective of the size, because there's an average size to the candles anyway. But this is very, very few candles. This is almost no volume today. So we're getting, essentially today's a throwaway day, and then things start to really move tomorrow, where we have some of the big earnings coming in the afternoon. We've obviously got the Wednesday Fed, and then we have huge earnings on Thursday as well, too. And then jobs on Friday. So it's going to be...
Yeah, don't forget about jobs.
It's going to be a big week.
And that's still a factor, I think. I think that still has some... And I don't know if we're back to, is good news bad news? Right. Too, so if there's good jobs report, is that bad news? In this environment, probably, there is nothing right now that is coming in data wise that would logically say the Fed should be cutting rates. There's a lot that says they actually should be raising rates. Right. And so that's the only other kind of thing that's lingering out there is could there be the, kind of signaling of a potential rate hike if things get worse? That would really throw markets in a tizzy.
Oh yeah, that's the phrase that shall not be uttered. I think that that would be I think the death of that would be the end of the term of Chairman Powell, because that would be twice now that he's missignaled the market. The old transitory all the way through.
Yeah, but if you look at the 70s, how the inflation spike went and then came down and then went back up again, we're following it really, really well. It's there is a playbook, or not a playbook, but there is precedence for how this happens, and that's why Volcker had to vote. If you remember what Volcker did, because the government was spending, we were running deficits. Volcker came out and said, your spending is doing this. And then he jacked rates to 19% and crushed the economy and got the government to stop spending, right? So, or overspending, if you will. That's what, he went and testified and said, this excessive spending is causing the problem. And then he jacked rates. Powell doesn't have the what's to do that. I think behind the scenes, he's parsing his words, but he knows that he's fighting a losing battle in this environment.
Yeah, this is the most, I think this administration, I think there's been some positives and negatives to it. And certainly if we compare versus 20 years ago, you had Alan Greenspan that would mumble something in front of Congress. Nobody could understand what he said. There was no press conference after a Fed brief. It was
No.
like your prototypical. It was like smoke comes out of the chimney, and then you're reading the tea leaves that comes after that, right? And so it was
Yeah.
weeks of trying to analyze what Greenspan said, and nobody could really understand it.
Well, and
And
you didn't
so
have 20 Fed speakers in a week either afterwards or anything like
that's
that
exactly
either.
right. That's the other point is that was the only data point was that Wednesday, every 6 weeks, you got a statement from Greenspan, and then you got the minutes
Yep.
a week or two later, and that was it. That's all that you were going to get. And anything that he spoke in front of Congress was purposely obfuscated because he didn't want to give away his secrets. And then you got into Bernanke, and Bernanke started to open the kimono just a little bit more. But Powell has made it his business to be very, very transparent. Right. I mean, there's zero drama going into Wednesday's rate decision. We know exactly what's going to happen.
Yeah.
It's all about the language. But the problem is that it's way beyond that. It is the 20 Fed speaks, that we have to deal with when they're off quiet period. So starting next week, we're going to have probably at least 15.
I know.
And all of these guys like elbowing each other out of the way, trying to get to the microphone.
And contradicting each other and everything else and stuff. It's a mess. It really is. But the data continues to come in. Inflation, all the inflation reports this time around were higher than expected. You've got GDP slowing. You can kind of just see where this train's going, but remember, it's macro, so it happens over a longer period of time. It doesn't happen, we're used to markets where, you're trading in a day or a week or whatever. It's a big giant cruise ship that takes some time to maneuver. And that's why I'm saying I think we get the recession next year at this point, because it takes that long for things to get to that point. And so I'm bullish on the rest of the year. And then next year is going to be, really a cautious one.
Yeah. So, that's kind of what Dave and I are saying is that we've got a little corrective period, which is going to maybe go through, it could be over this week. Probably not, but it could be over this week if we go above 5150. Probably there's a good chance that we extend this corrective move into May. And, by the time that we get into June timeframe, then all of a sudden, when everybody's most negative, all of a sudden we'll see this thing sprout wings and take off. And it's probably going to run into November at least with that. So we'll see what happens. But markets, again, the thing to remember here from a historical perspective is that every time we see a red candle, everybody just freaks out, right? Like, here it comes. Here's the bear market of 2024. Tops are a process. So we've got that monthly swing to the upside. It's just we have half of a red candle right now. So it takes a lot for a bull market to give up the ghost. It usually gets very, very noisy at the top. And lots of swings and then rallies to go almost all the way up to the top again. And in some cases even higher than that. Like October of 2007 was the bull market high for that.
You should actually show that because that's good examples on the screen. You can pull that up and kind of show, because this is what you watch for when you look for these patterns, because it's just human emotion, fear, greed, drive these things. So you see these patterns that do happen, over and over again through the market. It's never exact, but the general way that the market movement happens is that way.
So we just had a very similar move that I saw back here in 06, 07. So this is right around the beginning of my professional trading career. And then we got this nasty move like here. And that's very, very much like what we're seeing right now. It's very similar to what we're seeing right now. It was a very quick, complex pattern. We moved up to a new high. And then notice this one. Boom, all of a sudden, we come up with the first 10% correction that we'd seen in years. And then what do? We print new highs. And then notice how everything's getting very loud, very noisy, very volatile. And all of a sudden, all this bad news starts to come in. And from every bad news, we rally up to a relative high. And then we give it back again. So notice how things are quiet. And then all of a sudden, it starts getting very noisy. Starts getting very noisy, very volatile. You'll see this on the ATR. So this is one of the markers that we look for is the the character of the market being quiet into new highs. And this is where I'm getting this a little bit too messy here, but this is specifically where institutions will transfer inventory over to retail. And it's a process. It takes them a long time to do that because remember, they got millions and millions of shares that they have to transition over to retail, who then become the bag holders up there. And then this is where the institutions go short, or they use some other form of investment to meet their patterns. But they are distributing inventory at every single one of these relative highs. Every single one of these highs all the way along the way. So that's kind of the anatomy of it.
If you go to now, so let's look at just where we're at right now in context of this. So I think it's really good for people to see it.
Yeah. So I mean, look at this. We came out of a bear market. We had a relative bear in 2022. It was more than 20%. It was very average bear.
Yeah.
And then here's that same rally that we had back in 06, 07. And then here's our little 6% correction so far. So wherever this one ends up going, probably very, very good chance that by the end of the year, we're going to be printing new highs. Mm-hmm. Sometime this summer, maybe sometime this fall, we're going to be printing new highs. And everybody's going to say, how did that happen? The news is so bad. And it's just the nature of the beast. This is what happens to these things. And then eventually,
I also think being an election year, don't discount Janet Yellen, who's fresh with another, trillion plus after tax season in Treasury to move that liquidity out into the markets and stuff to keep things boosted. The last thing that any president or an administration wants is a stock market crash right before the election.
Which is what we had in 08.
Exactly.
Yeah, and we know how that turned out.
Yeah.
Okay, I'm not seeing any questions, so I'm going to assume that we have wrapped up for today. It was great to see everybody online. Thank you for joining us here today. And
thanks, guys.
We are going to have an exciting week in the markets, so I can't wait to come back here next Monday and opine on what happened. So it should be fun. All right. Thanks, everybody. Again, thanks for joining us, and we hope to see you next week. Take care.
Thanks, guys.